Okay, we have someone who's, I dare say, seen it all. Jahangir Aziz is head of emerging markets, economics research, and commodities at JP Morgan. Jahangir, great to have you with us here on the program. Thanks very much. Uh, let's just start with the latest problem, which is the banking giant Credit Suisse, which seems to be the epicenter of the troubles currently. Now, problems there have been well known for a while, well advertised for a while. Shares were down massively even before the latest episode of a sell-off. Do you really think, I mean, is it likely to fail? Let me put it very plainly, and then cause a worldwide contagion, or you think it'll be contained? What's your sense?
I mean, you've seen the moves by the Swiss government or the promises that you just spoke about. I think Credit Suisse for the Swiss government is large enough for it to be backstopped by the government. So I don't really think that you are going to see a failure of that. You can probably see that being, other banks coming in to bail it out, or the bank being restructured and different parts of the bank being separated, which was in the first place the plan to do so even before this event happened. So I really don't think that that is a bank that will fail, and you will see this massive contagion effect. I think though there are two parts to the story, right? One part of the story that we are all in the market and we all worry about the equity prices. There is the equity angle to it, and then there is the impact that the Credit Suisse has on the real economy in terms of its impact on actual credit that it actually delivers to let's say the Europe and to the rest of the world. I think the equity impact we've seen, it's terrible. It's really, really hard. So clearly equity owners of Credit Suisse will have been already battered by it. But that does not necessarily mean that the credit impact of Credit Suisse is going to be that bad, right? So I'm not saying that there won't be a credit impact. There's clearly likely to be a credit impact, but it will be taken over by the other bigger banks in the European time zone.
See, that's something that we can only guess, right? I mean, no one knows which way things are going to go. But the big question, Jahangir, I think the million-dollar question is what happens with the Fed? Because the Fed leadership for the last 1 year has been targeting inflation, with rate hikes, etc. But now things are changing on a dime with this whole banking crisis unfolding. What do you see the Fed do next week?
So I know this word is being thrown around because it's an easy word to use to describe the situation as a banking crisis. If you're going to call this a banking crisis with two small banks, relatively small given the size of the US economy, and let's say a handful of other regional banks also follow the same pattern as Raghu pointed out in the previous segment, then we really need to invent a new word for what happened in 2008. So I really don't think that this is a crisis, right? So first of all, let's just think. Secondly, if you have the largest bank in the world, central bank in the world, the Fed in this case, raised rates by 500 basis points thereafter, to expect that nothing is going to break would be something that has never happened before. When central banks raise rates by these kinds of levels, things break. When we talk about things, we never specify what things will break, largely because what will break depends on the specific balance sheets of these entities, the plumbing of the system. So the micro impact of these macro moves, we never really specify. But to expect that even in this soft landing scenario where the U.S. economy, which is running red hot labor market, will actually cool down to a mild recession and nothing is going to break in that process, that was a bit too much because that never really happens. So I think that even though we try to describe it in a very benign fashion by calling it a soft landings always include things breaking. Now, the question is the break large enough to stop the Fed from moving, which was your question. And right now, we don't think it is. If you look at what's happening to the labor market, what you've seen, what happened to the CPI, none of that points to the Fed actually pausing. We do expect the Fed to go 25 in March. We also expect the Fed to follow it up with a 25 in June. Without that, it is very unlikely that you can even get a soft landing if the Fed doesn't do that. And just to, I mean, and I'll shut up after this. Imagine this conversation taking place a week back. We will be talking about the Fed going with 50. So I think we need to put things in perspective a bit. Okay.
Absolutely. Jahangir, good morning. Great to listen to you as always. Surabhi here. I was looking at the CME Fed Watch tool. Now, a majority are saying no hike. Only, I think, 48. Last I checked a couple of hours back, were saying 25 basis points. So no hike is also on the table, it seems. But, my question is this, and I'm simply going to paraphrase Nouriel Roubini, Dr. Doom, as I ask this question. His argument is that once you get that landing, a soft or hard or some landing in the US, and as you're saying, things will break, that's when the credit problem starts to occur, which we haven't seen right now. And that's when you get into a full-blown crisis. That's his argument. I'm only paraphrasing it. But your thoughts to that?
My thoughts are that even to get to a soft landing, credit has to slow down and has to slow down significantly. Without a significant credit slowdown, how are we going to engineer a soft landing? Even that requires credit to slow down, credit conditions to tighten, banks to reduce lending, corporates, and in all of this, there will be micro stories in which some banks will go down under, some corporates will go down under. There will be sectors that will be hit much more than the other sector. And again, I'm going to go back to this description that the soft landing does not mean what we imagine it means. It's not a nice little glide down to some reduced growth rate and inflation automatically falls. So even if we do not even get to the point that Roubini is talking about, even in that process, we need credit to slow down. And credit slows down either from the demand side, when consumers and corporates, because of the higher rates of lending, do not want to borrow more, or from the supply side, where these increases in interest rates, deposit rates, losses to your investments actually forces banks to become or tighten lending standards, and they reduce lending. So both of them will have to happen. You really cannot imagine that economy of the size of the US slowing down after 2 years of red-hot economy without things like this happening.
Okay, your years of wisdom have provided it soothed our frayed nerves, I must assure you that. Because, you wake up every morning, and as commentators, you wake up every morning to news flow. You don't know how things are going to play out. But then we have experts like you joining us and telling us, you know what, it's okay. It's not a banking crisis.
But Sonia, I think he's just saying it nicely. He's still putting out all the worry points on the table. He's just saying it nicely with a smile, so at least we feel better.
Okay, glad to know that there's no failure of Credit Suisse coming anytime soon, and neither is this a banking crisis. At least that's your view. Jahangir, always a pleasure speaking with you. We'll catch you at another day. Thanks a lot for joining in. All right, that's JP Morgan.
By the way, on that Fed question, right, I mean, that proverbial saying, between a rock and a hard place. So we have the first test of that with the ECB meeting today.
Yeah.
So Fed is next week. ECB meets today. Till a week ago, people were saying ECB will hike. Consensus was for a 50 basis points hike.
Yeah.
And now in Europe, you have Credit Suisse and banking worries. Yeah. So rock, hard
Would you
place.
ever want to be a central banker, Prashant? Ever thought how it's like to be a central banker? Would you want to be one right now?
A little late in the day for that.
All right, we'll take a very quick break here. Our team's list of top stocks to watch lined up next. Stay with us.